just a quick announcement. During the break, if anyone wants, the Essex County CPA Association, they have a November 17th meeting on Friday at the Eagle Rock. It's actually at the Hanover Manor in East Hanover. I usually have 3 or 4 tax students who can go, and you can get free credit. And aside from getting free credit, all you have to do during the breaks, sit in front and promote Rutgers. What's to be easier and better? So if anyone's interested, November 17th, come up to me during the break, and I'm happy to sign you up. They usually have a great program. It's an easy way to get credit, and it's an easy way to support the program. So if anyone's interested or is able to do it, let me know. But be serious, because if you, it's a Friday, November 17th. It should be quiet that time of year for you. Consider coming, okay? Let me know during the break. All right, let's bring ourselves up to date. Partnership tax, as you know, is not for the weak of heart. I keep saying that. And for those, when I say that, not for the weak of heart, actually I left my calendar upstairs, but bear in mind that we have class tonight, we have class next week, but I believe, if I did my calendar correctly, our 7th class is in 2 classes, right? So, right, Alicia? So check your calendar. Our 7th class, I mean, time flies when you're having fun, but that would mean that our midterm exam would be in 2 weeks from now. Yes?
Yes.
Yes.
That's right.
All right, so, Luke, right, you got that?
Yeah.
All right, so that means you got to kick it. I mean, I'm sure everyone here is working hard, but you got to kick it up even harder, okay? So bear that in mind. All right, and I'll be around. So if you get stuck on anything, let me know. Let's remind ourselves where we are in this. So chapter 1 talks about, generally, what is a partnership. And by the way, no surprise, most of you probably were glued to your TVs today, or Google News, or whatever you were glued to hear about the president's tax proposal. I didn't think they were going to put it out there. I don't know if it's real. A 25% rate for quote-unquote small businesses. I can't see that, where that's going. I don't see, but we can be all very, very busy. And this course may, I said it was useful before, this course may be the most useful thing you've ever done in your career. How's that? A little pitch, if that truly comes to pass. All right, so we will see, but I can't tell you, if you saw what I saw, you said, okay, where's the detail? Do you guys see any details on any of this? I saw very superficial. So I don't quite see where it's going, but again, it's being floated. All right, so you guys know the difference between a partnership or corporation. We talked about formation issues. We talked about the red carpet treatment when it comes to formation issues. We compared and contrast partnership formations with corporate formations. We talked about the similarities, the differences. Again, for exam purposes, I'm not going to ask a single thing about corporate formations. Again, I think it's useful for people to just see the distinctions. Hopefully by seeing the distinctions, it will reinforce both in this course in corporate tax and in your practice how to handle formation issues. Formation issues are pretty straightforward. Emphasis on the word pretty straightforward, with the caveat that when property is contributed subject to a liability, it creates potential issues. Potential issues, we have to figure out if it's recourse or non-recourse. We'll get a better glimpse as early as next chapter, next class about, or if not next class, soon thereafter, about 752. We'll go into more detail. Again, why do the authors do that to you? Not to torture you. But property contributions sometimes do have liabilities attached, and you should be told very early on that you have to be sensitive to those issues. We moved on to chapter 3. We started operating this puppy. We looked into issues of assignment of income, which took a big backseat to reality. Again, big emphasis on the fact that we're going to let this go tax-free, and we're not going to worry about the assignment of income doctrine. We talked about the tax years of partnerships. We talked about tax consequences to partners, in particular, outside basis adjustments, okay? Outside basis, not capital account adjustments, outside basis adjustments. If the partnership makes money, basis goes up, partnership takes losses, makes distributions, outside basis goes down. So we discussed those concepts. Again, bear in mind throughout this course, certain things were dedicated to capital accounts and other things were dedicated to tax basis. So for certain purposes, you really have to keep your eye on the tiger. You're focusing on capital accounts. Other times, you're going to be focusing on tax basis issues. We then spent a good half a class, even more, on limitation of partnership losses, and I pointed out these are universal. They're not just limited to partnerships. And we talked about 704D and the need to have outside basis. We talked about the at-risk rules under Code Section 465, and then we talked about the passive activity loss limitation rules under Code Section 469. So we had this three-tier layer cake of limitations, and then that brought us into Chapter 4, okay? Chapter 4 deals with favorite topic of virtually everyone. Again, by way of comparison, some people have had, and if you haven't had, maybe you will have, Subchapter J of the Internal Revenue Code dealing with the concept of D&I. Because in Subchapter J, one of the pivotal things that distinguishes trusts and estates is Code Section 643, where there's this concept of distributable net income. Why am I raising that? Because that concept in the context of Subchapter J distinguishes it from other entities, meaning with a trust or estate, if distributions are made, the trust or estate has less income. If distributions aren't made, the trust or estate files Form 1041 and bears the tax. So it's a unique kind of thing because if you recall, with a corporation makes distributions, right? Is there any deduction for corporate distributions? And the answer is no. And a partnership, whether or not it makes distributions, the partners are still taxable on the income, correct? Correct, right? Code Section 701. And I'm just calling to your attention that trusts and estates have this lever of sorts, in the form of D&I, where it has a foot in both of these different realms. And why am I calling that to attention? Because many would argue that there's an equivalence here, or at least the distinguishing item of a partnership is the flexibility afforded the partnership to make allocations, right? And this is a distinguishing characteristic. You can't have this with C corporations, right? Can't have this flexibility. You either get dividends or you don't, right? You can't have this with S corporations. You either have one class of stock or not, right? It can be voting or non-voting, I'll add parenthetically, but you can't have multiple classes and things going on there. And with respect to trusts and estates, the beneficiaries get what they get. There's no, I'll call it, there's no special allocations akin to what's going on here, okay, or suggested to go on here. So we spent the vast majority of last class, almost its entirety, talking about partnership allocations. And I don't know, and I'm not sure if I want to be taped when I say this because it's such a bad metaphor. So I apologize for anyone who's watching this on tape, but we're in the throes of what happened with the NFL, about people taking a knee, about the national anthem. Well, here you have to pay respect, well, not to the American flag, but you have to pay respect vis-a-vis your capital accounts, right? To what's going on, right? So you got to take a knee. It's horrible. Bill's telling it like it is. I know. Okay, horrible. Okay, I don't mind it. If it's good, that's good. If it's horrible, maybe it'll be memorable. So you'll remember, like, years ago, someone compared this to taking a knee. What was he? Oh, now I remember. Paying respect, okay? So if it works because it's so bad, that's okay. That's okay in my book, okay? And I don't mind being called on it too. But if you have a better one, bring it on. I want to hear how you would pay respect to your capital accounts, okay? All right, so keep in mind as I flip pages, and we have the old rule where you just supposedly you can make allocations as long as they weren't abusive, but then Congress introduced this concept in Code Section 704 regarding substantial economic effect. And we said the test here for substantial economic effect, we were bifurcated, right? We first had to look at economic effect, right? See if there's economic effect, and then if there was substantiality, okay? And we first had to maintain our capital account, right? You have to maintain your capital accounts. And the authors give us lessons on how to maintain capital accounts, which are pivotal. Why? Because capital accounts represent our economic state, right, in the enterprise. They represent your economic state in the enterprise, and hint, hint, that means that if there is bank liabilities will not cause any increase or decrease in your capital account, but they may and will cause an effect under 752 in your outside tax basis, right? Compliments of the Crane Doctrine. All right, and on page 111, the authors outline, and this should, be comfortable for you. Page 111 talks about the big three. Capital accounts must be maintained, determined and maintained in accordance with the regulations. Upon liquidation, distributions have to be made in accordance with capital account balances. And finally, if there's a deficit in the capital account, someone's got to pony up, right? Okay. So if you can make the big three, so be it. And there's certain, and I said I would repeat myself, so I don't mind repeating myself. Bear in mind that for purposes of doing these tests, the adjusted basis of the property and its fair market value are presumed to be the same. Okay, the regulations make clear that the adjusted basis of property and the fair market value for purposes of capital account analysis are determined or deemed to be the same. All right. Now, the authors point out that there is an alternative test. The big three test is not a test that's going to be universal. Why is it not universal? Because many partners do not want unlimited liability. So they don't like the third leg. So they're willing to have their capital account go to zero, but not below zero. And if it does, they want to have, or need to have, if it's going to be respected, something known as a qualified income offset, right? So that if they do go negative, they're going to be fed as much income as possible, as quickly as possible, to get them back into positive territory. All right? So we have the big three, we have the qualified income offset, and then if by default you don't meet any of those, either of those I should say, you have the economic effect equivalence. And that's essentially are the allocations being done in HIT in accordance with the partner's interest in the partnership. The partner's interest in the partnership. Then we looked at the issue. So once we have economic effect, we looked at the issue of substantiality. And the issue of substantiality from 30,000 feet up talks about vis-a-vis the allocation. Is one or more partners better off and no partner worse off as a result of the allocation. So as a result of making this allocation, is one or more partners better off economically, and no partner is worse off. And we have shifting allocations and transitory allocations. Shifting allocations look at a particular year and seeing if the allocation produces or yields, like I said, where one is better off and no one is worse off. Transitory looks over a series of years, 5 years to be exact, and compares if under a longer window of period of time, is one person better off and no person worse off. All right? I said to you before, again, being repetitious here, that if you read the regulations here, guys, very hard to get much variance for exam purposes. And we went through the problems. We spent a fair amount of time on the problems on page 134, 135, continuing on to page 136. Hopefully you got a gist of that. And then I spent, towards the end of class, about a half an hour talking about allocations attributable to non-recourse debt. And in this sphere, with respect to these allocations, we said, by definition, they cannot have substantial economic effect, right? They cannot have substantial economic effect, right? Because we're sort of playing with other people's money, right? Because we're dealing with non-recourse, so there's no recourse to the person. So you're playing essentially with lender's money. So the deductions you're taking can have substantiality insofar as you're not going to have to pony up the money. Agreed? Agreed, right? So how do we respect those allocations? Well, if you recall, again, from your days of income tax and the Crane case and the Tufts case, is that when you have liabilities and you have adjusted bases that are less than the amount of the liabilities, you have a built-in gain. Everyone agree that you walk away from that property, that's the quintessential so-called phantom income, right? Because you have gain recognition, but you have no cash. And you may have heard me before, often your sympathies should not go too deep for these taxpayers because inevitably they probably had a fair share of write-offs that got them to that position. So this is not something that should be unexpected, that down the road they may have to recognize gain. So for these deductions or these allocations to be respected, the document must contain a so-called minimum gain chargeback. So essentially, if you got the benefit of these deductions, and these deductions can be depreciation or, hold on, depreciation, or alternatively, our authors and the regulations point out two other events that can give rise to non-recourse deductions. The partnership can refinance, take that money, and spend it on deductible items, and whoever gets the benefit of those deductions, or allocated the benefit of those deductions, subsequently will have to pick up the gain. Or there can be non-recourse distributions, right? Where the money is borrowed and it's distributed to partner A, B, and C. Well, if and when they walk away, or there's a gain, or there's a reduction on the non-recourse deductions, anytime there's a reduction in a non-recourse deduction, there's a possibility of income inclusion. We'll go through some examples of this. That you're going to have to trigger that makeup provision. So let me just repeat for our purposes. There can be three events that give rise to a non-recourse deduction. The first event that we'll see mostly are depreciation deductions. Okay, they're allocated depreciation deductions. The second is when the partnership borrows money, non-recourse, it makes certain deductible expenditures and allocates those deductible expenditures to certain partners. And the third is partnership borrows money against depreciated property and makes distributions. And whomever receives those distributions has some subsequent exposure to income recognition. And generally, however you allocate the non-recourse deductions has to be consistent with your other items of income or losses. So whatever you do with respect to your other items of income and loss, that's how you can allocate your non-recourse deductions. But again, there must be this consistency. So the authors point out the safe harbor test, and we began on page 146 looking at this problem. Before I go on, I'm going to look at this problem together. Any questions logistically, substantively, things that are bothering you? Everyone's good? Go ahead.
I just have a general question, just so you realize. When we're studying this stuff, is it how important is it to memorize the exact regulations, or just read the regulation and understand the rule without understanding, like, you know?
I mean, the exam is going to be open book, open note. So Andrew, I can't answer your question. I mean, depends on how you know, what methodology works best for you to study. So obviously, knowing the general concept is important. You're not going to have to cite to a particular regulation, okay? So don't be unnerved. Like, I'm not going to need you to say, well, which example in the regulation supports this proposition? So I hope that helps.
That does.
Okay, other questions? All right. Anything to report, movie-wise or otherwise, cultural? No cultural events? Go ahead, Karen.
I went and saw Swan Lake on television.
Oh, you saw what?
Swan Lake,
Swan Lake.
LA.
Yeah, where? In New York?
It was New York City, LA actually was kind of fun. So usually like ABC does those big, long ones, but this is good.
I am seeing, and I should not, maybe I should be embarrassed to tell everyone this, so, but I don't know if I like being taped on a truck.
I can edit it out if you want.
Right, I don't care. I am seeing, who's the woman who stars in Younger? The show, Younger? No, not Hillary Duff, who's the lead? Oh, you guys have to see that. Well, what? She's
Sutton Foster?
yeah, Sutton Foster. She's coming to the Morristown Theater, and she's giving a performance a week from Friday. So if you remind me, I'll give you a full review on the Sutton Foster, who apparently is in a number of Broadway shows, but she also stars in this other show that my wife finds entertaining. All right, you guys ready? All right, let's get through this. Page 146. Now keep in mind, because I know students in the past, not you guys, but people in the past, they get lost because if you look just a little, foreshadowing. Chapter 6 deals with partnership liabilities. Partnership 6, the main focus is on outside basis. We are focusing for the moment on capital account allocations. Everyone understand? We're focusing right now on capital accounts. And I'm sorry for the repetition, but I'm telling you, I know by now you know where common mistakes are. That's one of them. We're talking about capital accounts and properly maintaining them. All right, so if you recall from last week towards the end of class, G&L formed a limited partnership. The general partner contributes $80,000 and the limited partner contributes $320,000. They go out there and they buy a commercial building with that $400,000 of cash, and they borrowed $1.6 million on a non-recourse basis. Non-recourse basis. The terms of the loan require the payment of interest only, so it's a balloon mortgage. So that $1.6 million, guys, guess what? It's going to stay out there. Everyone agree? It makes it easier to follow this. The partnership agreement allocates all income gain, loss, and deductions, 20/80, right? Till the first time the partnership has recognized items of income and gain that exceed items of loss and deduction recognized over its life. Then all further partnership items are to be allocated equally between G and L. At the time the partnership agreement is entered into, there's a reasonable likelihood that over the partnership life, it will recognize amounts of income and gain significantly in excess of loss and deductions. The partnership
Those allocation terms in English.
Okay, what they're saying essentially is that Dill and I went into this partnership agreement. One of us is the money person, one of us is going to bring the experience to the table. I'll be the money guy, okay? And Dill's going to bring his wealth of knowledge. And I'm saying, look, I'm putting up this money, and assuming you do your job, Dill, I'm putting up a lot of money.
Right.
I have great expectations you're going to deliver. If you deliver, and this takes off, then we are going to, once we start being profitable, first I want my 320 back, you want your 80. And then once that happens, we'll split things 50-50. So I'm
So it's up
expecting.
to initial contribution. That's essentially saying what that. Hang on. That's essentially what that's saying.
Yeah, it's saying with respect to the initial contribution, we're each going to put up this money, but we want to get it back. I'm going to sit in the sidelines.
Right. So after you get it back, then split it 50. That's what that's saying.
Right.
Okay.
All right, everybody got that? This is not uncommon. To the contrary, this is fairly common. People put in money, they want to get it back, and then we'll split it 50-50. But let me show me what you got.
Understandable. It's the legalese that's confusing.
Yeah. The partnership agreement requires that all allocations should be reflected in the appropriate adjustments to the parties' capital accounts, and liquidation proceeds are to be distributed in accordance with positive capital accounts. Okay? Positive. Something may be wrong again, Mark. Right? Only G is required to restore capital account deficit. The partnership agreement, though, contains a qualified income offset. Okay, good. We meet the alternative test. And it also has a minimum gain chargeback, right? So it looks like we can do non-recourse allocations. Finally, the agreement provides that all non-liquidating distributions will be made 20% to G and 80% to L. A total of $400,000 equal to the original cash contributions have been distributed. Thereafter, like I mentioned before, distributions will be made equally to G and L. The partnership depreciates its property using straight line method over a valid, let's assume a 10-year recovery period. So we're going to ignore, for those who've had income tax, generally you have a mid-month convention, all sorts of things that might be going on. We're ignoring that, okay? So if we do the math, and I think everyone here can handle it, how much depreciation do we have each year? 200,000, okay. I wouldn't want to ask that question at 8:30, but 6:30 I can ask, right? Okay. Assuming that rental income from the property of $150,000 equals its operating expenses of $150,000, determine the allocations of the partnership cost recovery deduction in each of the 3 years of operation, and determine the partner's capital account at the end of each year. Okay? So, let's set the tone first. What's their initial capital count?
8,000 and 320.
Okay, we're good, we're good. Okay, and again, capital counts, no secret here. You're going to find these, where you need to maintain capital accounts, 704-1B2, 4i B. So, Andrew, not to unnerve you, but I can't resist giving a site. 704-1B2, 4 little i's, B. Okay, so we got to Just maintain our capital accounts. And keep in mind that the liability, right, is $1,600,000. Everyone agree? That's the liability. And that the first, we buy the property for $2 million. And year one, we take how much as deductions? 200,000. Year two, 200,000. This is year one. Year two, and then last I checked, everyone agree? Code section 1016, right? And we make adjustments for the basis and we reduce it accordingly, right? And when you do that, for the moment, and then we'll get back to the capital accounts, what jumps off the page, a little foreshadowing? Andre? Say again? Just what jumps off the page once you see this and this? Eric?
Your basis is less than your liability.
Less than liability.
Basis is less than liability, which we call what?
Bad.
Let's call it by a better name if we want to get paid our hourly fee.
Partnership minimum gain.
Partnership minimum gain, right? Minimum gain, everyone? And we would call this $200,000 a non-recourse deduction, right? Because it's giving rise to a minimum gain. Louis, you got that? You got that?
Yeah.
All right, hear it? You got it? And does this reek of Tufts? Sure. In the Tufts decision, if you recall, they took the partners in Tufts took depreciation deductions. Their adjusted basis went down, the liability stayed the same or was in excess, and they walked away from the property, right? So this is our capital account starting. What would you do, Lisa, with respect to the capital account in year one? Say again, Lisa? You not sure? Jackie? What would you do with their capital account, Sal? I mean, I'm not trying to be cryptic here. Nothing? But I want Amar to repeat that, but I don't know, I may want to repeat it because it won't get people to think but not to think. Go ahead.
I'll take the depreciation deduction.
Okay, so you said something else. So what would you do year one capital account? How would it?
G gets a deduction of 40K.
Okay, why do they say 40?
It's like because there's 20% of the deduction.
The deduction is 200,000, right? Everyone agree?
Yes, sir.
20% of 200,000 is 40. And how much out?
160.
160. Everyone agree? Because everything else, the operating income, operating expenses are equal. So we just have to allocate the depreciation deductions, and we're doing it 28. Agreed? And since you did that so well, Amar, what happens in year two?
It's the same thing.
Same thing. So the capital accounts,
Zero.
guess what? At the end of year two, 2 goose eggs. Okay? Now, I will just call to your attention that we have a minimum gain here, which I called in year 3. This is found in Regulation 704-2C, that there's now a $200,000 minimum gain. And this deduction, right, we have $200,000 of deduction coming in year 3. And normally, can we give L, can L go into negative territory normally? No, everyone agree? Did we learn from last class that L cannot go negative, right?
Because there's no deficit.
There's no deficit makeup,
Yeah,
right?
that's the word.
Everyone agree? Can't go negative.
But don't they have the qualified income offset? now?
Remember, even with a qualified income offset, you can't go negative unless it's by accident, and then you have to allocate the income as quickly as possible. All right, so generally, we can't go negative, but now we have $200,000 in deductions that we have to allocate, right? And how are we going to do that? Kelly, what are we going to do? You're whispering.
I'm not sure. The deduction.
Say again, more? You're on a roll.
Take the deductions, 50% G and 50% to L, since this is a non-recourse.
But why would you do a 50-50? What tells you to do a 50-50?
Because they both are in for the non-recourse normally.
Are they both in? Anyone want to have a different answer? How you would allocate it? I'm not saying they're wrong, but anyone?
I would take 4160. In normal case, this one should be make profit. So in normal case, it will be like 50-50 after they have.
So they haven't made profit, so.
Yes, right, but you assuming they will be. So based on the situation, you probably have to make condition or assumption.
But can I make the observation right now? They ain't making money. And they might, but we don't know that. But as Alicia said, right now they're losing money, right? Maybe not economically, but on their books they are. And the partnership agreement says losses are to be allocated 20/80. Everyone agree? Everyone's sitting down for this, right? We, together, I should say, sorry, Bill, we can lock arms here. And
I mean, there's always the classic throwing the child into the volcano. We can do that.
we can do that, but we're not doing that. We are locking arms and we're all smiling, right? We are going negative. And can that be respected?
Yes.
Yes.
It can, because our agreement has a minimum gain chargeback. And guess what? Does Congress feel shortchanged?
No, because they're gonna get their money.
What do you mean? First of all, it's not they, it's an it. Congress, it will get its money. But is this fair? Is this abusive? In other words, if they walk away from this property after year 3, capital count year 3, if the partners walk away, guys, who's going to get hit with the money, with tax liability? The partners will, but how will it be split? Oh, gee, you got $40,000 deductions, you got $40,000 in income. You took 160, you get 160. These have no economic effect, right? They do not have to pay. Normally, right, don't you have to pony up? You have to pay out? They don't have to pay a dime, but they have to pay the tax on this, right? Everyone got that? Capital accounts usually represent your economic state, what you have to put back in. They don't have to put a dime back in. But because there is a minimum gain chargeback, yes, they got the deduction. But they better be aware that down the road, they may have to pick up the income. Now, if you don't see this, this is critical, and the rest of tonight is not going to, well, not the rest of the night. The next hour, you're going to be completely lost if you don't see this. So, someone not see this?
So, at the end of year 3, they have to pay taxes on their 40.
No, they do not. They do not. Only if they walk away from the property.
Okay.
And this property, we're not told. Maybe it's now worth $3 million, and they're not walking away, right? If the value, fair market value of the property is in excess of this liability, they're not walking away, right? Everyone agree? They're not walking away from this property. But if the value of the property dips, the fair market value, say to 1.5 million, they may walk away, right? And under Tufts, what's their amount realized? Is it the 1.5 million fair market value, or is it the 1.6 million liability? 1.6 liability, right? And the basis is 1.4. They're going to be stuck with a $200,000 gain. Who's going to pick it up? They're going to pick it up in that proportion, right? So what I don't want to leave you with the impression is they have to recognize income at the end of year 3. They have the potential to recognize income if they walk away from the property. Right? Andrew.
But that could even be like right out of their pocket, and that doesn't necessarily have to come from,
I don't know what you mean out of their
it
pocket.
doesn't have to come from a gain from the partnership.
Like
Like an
give
economic
me a
gain.
scenario. I'm not sure what you're saying.
Like say that they had a loss of $200,000 on the building that they have.
When you
so
say the
they
loss,
have-
meaning the fair market value is what? Give me a
I
number.
guess it's 1.4, right?
Well, that's just the adjusted basis, it's not the fair market value.
Yeah, but if you're saying that the amount realized is then 1.6, a $200,000 loss.
Hey, it's always going to be, and I didn't say it's a loss. Andrew, they're having a gain.
Yeah.
There's no loss. They
Right.
don't bear the consequences of loss. The bank does. Right?
Oh, it's non-recourse.
It's non-recourse. That's critical. Everyone understand this is non-recourse. That is why there's no substantial economic effect. This can't possibly have economic effect, this allocation. They don't owe the money. But they will be hit, and hit hard, with a minimum gain chargeback if and when the property is sold and there's a minimum gain.
So they allowed to have a negative capital.
They are allowed to go negative. And I've heard so many accountants and lawyers say, oh, these guys have negative tax bases. I want to choke. Okay? They do not have negative bases. Okay? Everyone agree? They have negative capital accounts. They do not have negative bases, right? They cannot have negative bases. There is no such thing.
I'm okay with the whole concept of going negative and PMT, but I just don't get it, why it's not 50-50 and why it's 40-60.
Because they agreed to share their losses until there's income 20/80.
So it's based on that and not just the fact because they both are in equally in that.
They're not in equally. Until there's income and they're really profitable, and it's not 50-50. And the government doesn't have any skin in this game because, hey, you want to allocate it this way, there's no abuse, it's consistent with your other allocations, right? And if and when they have to recognize the minimum gain, they'll each be tagged with whatever deductions they had before. So, hey, they could, and we're going to see an example, they could agree to make their non-recourse deductions allocated 50-50, and the government would respect that too.
Oh, so that's based on their agreement and not present.
It's based on their agreement,
Okay.
okay? Joe?
Not to throw a monkey wrench into this, but if they didn't have a minimum gain chargeback, what do you do with that $200,000?
If they didn't have a minimum gain chargeback, in my opinion, it's got to be, I got to think about this. It's got to be allocated in accordance with the partner's interest in the partnership. And it might get you back here because at the end of the
Happens to be
day,
that way, right?
it could happen to be that way. Brandon, you ready?
Yeah, so let's say, so year 3, we added and they're not walking away, they're staying in. Their capital accounts on their K1 will show those numbers, the
Yeah.
-40, -160. Then and then in year 4, if they elect to, let's say, get out then they would do the chargeback calculation. Okay.
Let's keep going, because I think if we do some more, you'll hopefully absorb more. And let me just, see what else, okay. Question B. Same as A, except the partnership agreement provides that L will be allocated 99%, and G, 1% of all partnerships' cost recovery deductions. Okay? So, what is their starting capital accounts? 8320, okay? Now, at the end of year 1, what are their capital accounts? We know it's $200,000 of depreciation, right? And how are they allocating that deductions? Because it's only pertaining to the 200,000. 2,198. Everyone agree? Now, does that year 1 allocation, Eman, does that have substantial economic effect? Andrew shaking his head no, Eric saying no.
Yeah.
Why not?
Shifting.
Why is it shifting? What tells you it's shifting? We're not told anything to allude to the fact that it's shifting. Right? We don't know what the tax brackets are. We don't know tax exempt or not. There's nothing here to say shifting. Andrew?
It's outside their allocation percentages, like.
But that deals with non-recourse deductions. Do we have a non-recourse deduction in year 1?
No.
No. Everyone agree? In year 1, there is not. Our liability is 1.6 million. The adjusted basis is 1.8 million. Okay, so there's no non-recourse deductions. So, can you allocate it any way you see fit?
Pretty much.
Pretty much, right? Isn't that the beauty era of partnerships? And at the end of the day, if the partnership were liquidated the next day, who's going to get what? G is going to get 78. L is going to get 122. Everyone agree?
Right. Right, because it says it's by positive capital. If it said 50-50, then this one would not be okay.
Yeah. I mean, you got to respect. I'm battling of sorts. You got to respect the capital accounts. Everyone agree? This is what we did last class, guys, right? This is exactly what we said. Do whatever you want, right? But just respect those capital accounts, right? Agreed? Now, don't say it out loud. Take 30 seconds and tell me what happens in year 2. Lieutenant? What are you gonna do in year 2? Just say it loudly until here, see if you agree.
I got 76.
I'll just write it down. So what should I do?
76 for G.
76 for G?
Oh no, minus 2.
Minus 2. You would make this minus 2? Okay. And what about, will you do 198? Is that what you're suggesting?
Yeah.
Do you agree? Think so? Anthony?
I agree.
Would this bring L into negative territory?
I don't think
Isn't
that's allowed
that,
to go
isn't that
negative.
prohibited, guys? Can L go negative?
No, because L's not.
L
required
can
to go
categorically not go negative. Everyone agree? That's taboo. There's other taboos society have. We have one taboo here. You cannot go negative here, right? If there's no minimum gain.
down. Right, because this isn't a minimum gain.
There's no minimum gain, right? Everyone agree? In year 2, is there any minimum gain here? Louise, any minimum gain? No, right? The liability is 1.6 million. The adjusted basis is 1.6. There's no minimum gain. L cannot go negative.
Because L is not required to.
L has no requirement to kick in money,
Got it.
right? L has no deficit restoration. He can only go negative in the first problem because there's a minimum gain charge back and there's a minimum gain. There is no minimum gain here, right?
So L would go to 0.
L would go to 0. So you can get 122.
What is that, 78?
78. Guess what? We're back to 0, 0. But L cannot go negative. So we cannot respect that allocation, Lou.
So L could go negative.
I can't even go there. My brain can't go there. Sorry. It's just true. I can't even, it's not, I don't mean this badly. It's like saying if the sky was red. I mean, it's illogical. It's not going to, it's almost going to distort our thought process. Okay? Louis.
So since L can't go negative, you just allocate the rest
You
of
have to.
the
We did that last time. Okay? When we were allocating with respect to recourse. Once the L went to 0, can't get any more because he has no obligation to restore anything. And there's no minimum gain.
So if this happened in the year 3, so
Well, we're going to get to year 3 now.
I'm just assuming this happened in the year 3, so one can get, L can get negative.
Well, everyone agree with year 2? Okay, now ready to move on to year 3?
Yep.
Now, and here's where Andrew might chime in and say, look, we got to be consistent, right, Andrew? Because the regulations, right? The regulations, and by the way, for this problem, I'll just call to your attention about the fact you can't go negative. The examples, surprise, the examples under the regulations, 704-1B5, that's where the examples are. 704-1B5, example 1, for little I. Example 1, for little I, for this proposition. Now, insofar as year 3 is concerned, we're dealing with, go ahead, Amber. We're talking about 704, regulation 704-1B5, example 1, for little i's. Now, regarding year 3, we are going to have a minimum gain. Everyone agree?
Yep.
Year 3. And the partners would like to allocate it 198, would like to allocate it this way, but they can't because their non-recourse allocation deductions have to be consistent with their other allocations. And remember, Dylan and I are going to this partnership. We allocate the losses 20-80 or 50-50 this is outside, right, that range. It's 99.1. So we can't do this because you can't allocate non-recourse deductions outside that range. That's under 704-2E2. I'll repeat, 704-2E2 for the proposition that it has to be reasonably consistent with other allocations that have economic effect. And you probably want to see an example of this in the regulations, Andrew, right in the 704-2M, example 1, 3 little I, I'll repeat. 704-2M, example 1, 3 little I, says that we have to be consistent.
So we go back to the old allocation of the 8 points, so 40,
Then
60.
the regulations say it has to be in accordance with the partner's interest in the partnership. So you go to a default rule of the partner's interest in the partnership. This is under regulation 704-1B1, 1 little I. I'll repeat, 704-1B1, 1 little I. And there's another regulation, 704-1B3, 1 little I. I'll repeat, 704-1B3, 1 little I. And it's left open what that allocation should be. But it's going to be either 20-80 or 50-50. All right? But it can't be 99-1. So this problem B is to show or demonstrate two propositions. Proposition 1 is if there's no minimum gain, once again, from last week, last class, your capital accounts for a limited partner can't go negative, right? The second proposition is one that Andrew alluded to earlier, is that your non-recourse deductions have to be consistent with your other deductions. Problem C. Same as A, except the partnership agreement provides that L will be allocated 70% and G 30% of all the partnership non-recourse deductions. Okay? So we're going to just go back to this problem, problem C, and just say, can this be done? Where in problem C, it says it's going to be allocated 70-30. So it would be negative 60, negative 140. Javier, what do you think? Thumbs up or down? Roman gladiator system.
Thumbs down.
Thumbs down? Can't do it. And Anthony, you agree?
Yes.
Can't do it.
Can't do it.
Michelle?
You said reasonably
Okay,
consistent. I don't like that word.
Javier? Anthony, why can't you do it? Why are you giving the Roman gladiator thumb down, head off? Lying in.
I think the 70-30 is still different than the 50-50 or 20-80.
Isn't it somewhere in the middle?
Yes, it is.
Yeah, it is in the middle.
I don't like that word, reasonably consistent.
I mean, I don't think there's a problem here in the regulations, guys. I will just say that the regulations here would say, this is under 704-2E2. I'll repeat, 704-2E2. And regulation 704-2M, example 1, 2 little I. I'll repeat, 704-2M, example 1, 2 little I. Would say this is reasonably consistent. This is doable.
Question?
But Because that's what problem C said go back to A.
Yeah, but it starts
Even
in year
if
one.
But it's
Yeah.
non-recourse.
Year 1 and year 2 are
It's the
missing.
same for year 1 and 2.
Year one,
Year 1 and year 2 are the same, because these are the only non-recourse deductions, guys. The other deductions were not non-recourse. So they're saying, when you start getting into non-recourse deductions, it's only in year 3 that there's an actual, look at it, you see that, non-recourse deductions, okay? You got it? You're good, okay.
Professor, is there like a range, I know the regulations are reasonably consistent, that we should be looking for to measure this one up?
No, I mean, but you know 99.1 is
Yeah.
out of the
I know.
range, and this is between them.
Okay.
So, look, they're just, the regulations are trying to say, if you're 99.1, something strange may be going on, like you're playing it out a little bit too much. Something in between, no one should worry about this.
Yeah, okay.
so when you're talking about non-recourse deduction, that means anything above their basis, above.
I don't know if you want to say anything about their basis. Anytime the liability is in excess of the just basis, that's a minimum gain, right?
So
Right.
year 1 and year 2 is not considered non-recourse.
Right.
deduction. Year 3 only because you
Right.
max your basis.
Guess what, in year 4, the minimum gain is going to get larger. Right? Because the just basis keeps going down, and the liability, the way this is portrayed, stays the same. Luke, you had a question? Or?
So if they start to produce income, their capital accounts go back up.
Right. Okay. Question D, I think we left off. Again, if the property were just like, oh, I mean, I'm just going to state the obvious. G would pick up 60,000 of income and L would pick up 140.
Yep.
Question D. If the allocation under the minimum gain chargeback in A above, if at the end of the year, at the end of year 4, G contributes 80,000 and L contributes 320 to the partnership, it uses the funds to pay down the $400,000 of liability. Okay. So in question D, if you don't mind, we're going to go back to A. And I think we have year 4. What is the minimum gain now?
400,000.
Everyone agrees 400,000. Everyone agree? Where's that number from? The liability is stated 1.6. The adjusted basis is 1.2, right? We have negative capital accounts, but no one's falling off their chair because these pertain to non-recourse deductions, right?
No. Didn't they put the money for 100?
But we didn't get there yet. I meant.
Oh.
Right? Now, they're making, in problem D, they're making capital contributions, right? So, I think you hinted at it before, what's going to happen to their capital accounts? When you make capital contributions? Mara? They're going to go up. By how much?
Whatever you think.
8320, right? Now, that means the liability now is 1.2 million, right? Because we're using it, right, to pay off part of the liability. Everyone agree? And I will just call to your attention that normally, when you have a decrease in the minimum gain, that triggers income. When you reduce your minimum gain, that triggers income. Was my authority? 704-2F1. I'll repeat. 704-2F1 says, hey, if you reduce the minimum gain, to the extent you do, it's got to be picked up by income by those who benefited from it. However, 704-2F3, I'll repeat. 704-2F3.
Can you repeat the first one again, please?
It's 704-2F1. Now, there's an exception under regulation 704-2F3. Says that you do not have to recognize income under that regulation if the funds are used to, if there's a capital contribution, and the capital contribution is used to repay the non-recourse liability. I'll repeat. There's an exception that says if you use the capital contribution and you use it to pay down the non-recourse liability, that will not trigger income. And, not surprising, there's an example exactly on point. 704-2M, example 1, for little y. I'll repeat. 704-2M, example 1, for little y, for that proposition. So there would be no income here, notwithstanding that the minimum gain has been reduced here by $400,000.
So if they just had operating income and they use those funds to pay off the...
Then it would have to be, if you just had operating income, the operating income would, of $400,000 would have to be allocated in this fashion.
Okay.
Okay, if the operating income was to be used, if they just had $400,000 of operating income, G would be tagged with 80 and L would be 20.
So that's the income they would, I mean, that's that income that 704-2F1 is talking about? Or?
No, well, here it's a capital contribution. It's
No, I understand. So, but hey, you said if you decrease the minimum gain, it produces income.
Yeah.
That's...
I mean, but you gotta come up with what's being used to reduce the minimum.
Right, right. So if they use their operating income,
Then they will, yep. Then they have to, they'll be tagged with the income in that ratio, 20-80 ratio.
Okay, but it's not additional income, it's just the operating income itself.
Yeah, absolutely.
Oh, okay. I thought, okay, it sounded like you were saying you have to
No.
come up with random income from somewhere. Okay.
No random income. Kelly, you had a question, or?
Oh, never mind that.
All right, you good? All right, question E. If there's an allocation under the minimum gain chargeback in A above, if during year 4 the partnership converts $600,000 of the non-recourse liability to recourse liability. Okay? No? Now, we're going to convert. I know, not a religious conversion, but it's going to feel like that. It's going to be not going to be easy. Okay, so we agree the capital counts, right, at the end of year 3, right, the negative 40 and negative 160. Agreed? And during year 4, we're going to convert this liability $600,000. Now the liability only $1 million. $1 million is going to be non-recourse. Everyone agree? So do we have any minimum gain here? We have no minimum gain. Agreed?
4, right? So just.
This is at the end of year 3. This is during year 4.
Oh, okay.
Okay? Everybody agree, we have no minimum gain. And holy schmoly, we're in negative territory, right? And there's no minimum gain. What are we going to do?
There's regulations.
Well, aside from the regulation, what gets triggered here? Let's see who's listening. Who has their got their double espresso going? What would you do here? What provision in your partnership agreement now gets triggered? There is no minimum gain, so let me help you here. There is no minimum gain chargeback per se because there's no minimum gain. The poof disappeared.
Qualified income offset.
Who said it?
Qualified income offset.
Qualified income offset, okay. So you're right, Louis. Tell me, how are we going to apply the qualified income offset, right? We got to get back to 0, right? And what are we told? There's $150,000 of income, $150,000 of expenses, right? And $200,000 of depreciation deductions, right? Everyone agree? So, can we get back to 0 this year? Well, we want to get L back to 0 as quickly as possible, right? Everyone agree? Why not give him, lucky him, $150,000? Remember, there's operating income of $150 and operating expenses of $150, right? Heck, we'll just give him all the income. What will we do with G? Because G can go negative big time because this is, you remember, we converted the liability, right, to $600,000 now converts into recourse liability, right? So we have no problem with G going negative, right? So we can give G $150,000 of expenses plus the $200,000 of depreciation deductions. So we can go, G can go down by $350. Again, where did that $350 come from? Operating expenses and depreciation deductions. So the capital account here will be $390, negative $390, and negative $10. If you want to see this in action, this is under 704-1B5, example 1, 4 little i's. I'll repeat, 704-1B5, example 1, 4 little i's.
So where does the income from reducing your minimum gain come into play? From the last example, you said if we reduce.
Well, essentially, we're doing with this qualified income offset, we're getting to the same end, right? Because we're allocating all the income here,
Okay.
right? And all the deduction here because he can be negative, he can't be negative.
Right.
But we can't get him all the way up to 0 yet because
We don't have enough income.
We don't have enough income. So we have to figure out in year 5. In year 5, there's still no, right? This is year 4. And there's another $200,000 of deductions, right, in year 5. This is year 4. This is year 5. So even in year 5, there's no minimum gain, right? Everybody agree? In year 5, there's no minimum gain. Our basis is $1 million. The liability, the non-recourse part, is $1 million. So
Just to make sure, there is no no minimum gain, so all the deductions will be given to G all these years then?
Well, first of all, we have to give L, right, 10,000 of income, right? Everyone agree? We gotta get them up to zero as quickly as possible. So with respect to that $10,000 of income, right, we have remaining $150,000 worth of expenses and another $140,000 of operating income. I'll repeat. We have $150,000 of expenses, right? That's what the problem tells us. And we now have only $140,000 of income, right? Because we gave 10 here, right? So
Plus 200,000 depreciation.
plus $200,000 of depreciation. So that means there's $210,000 worth of expenses here. He's going to go down to what? $600,000. Why? Again, because of the qualified income offset. Remember, I will say this again, that the deductions total $350,000, right? 150 of expenses were told in the problem plus $200,000 of depreciation. And there's only, after we allocate the 10 here, right, there's $140,000 of remaining income. So if you take $350,000 of deductions minus 140 of income, that's where you're left with $210,000 right here.
I don't get why, like, can you explain why, the provision that one's partner being better off, like, and the other one worse off, you know, that?
But that's dealing with shifting and transitory allocations, but nothing in this problem suggests that there's a problem with that as this is framed. Because that usually engenders where taxpayers are at different tax rates, someone's taxable, someone's not. Nothing here indicates that. Someone's in a higher rate, someone's in a lower rate. That's not the question right now, Brianna, we're looking at.
Okay, because if, like, he was going, let's say, like, one was going positive, negative, that
This
might-
has to deal with the issue of non-recourse deductions. Okay? And this makes sense because there is $600,000 of recourse liability and G is now on the hook for that. Go ahead.
So is the reason G's allowed to go negative because they have the requirement to restore the negative deficit?
Yeah.
That's why it's allowed, and because he's on the hook, okay.
Okay? Next question. So this is capital count year 4. And this is capital count year 5. Question F. What results under the facts of A above if in year 4, in that year the property had appreciated value, the partnership incurs an additional $300,000 in non-recourse liability, and now it's going to make a distribution to $60,000 to G and $240 down. Okay? So we're back to $1,600,000 liability initially. And then, I believe our adjusted basis, we go back to, at the end of year 3, it's $1,400,000. Okay? Let's go back to capital account, the end of year 3. Okay. So we've taken depreciation deductions. We have originally in year 3, if you recall, non-recourse deduction of $200,000, agreed? That's how we left off, because the liability is in excess of adjusted basis. But, and this is not uncommon, they're going to incur another $300,000 in non-recourse deductions here. So the liability is going to go up to $1,900,000, right? So what's our minimum gain here? 500,000. Everyone agree? I will give you a regulatory site. 704-2H1. I'll repeat. 704-2H1. That a distribution of non-recourse liability allocable will be the distribution of non-recourse proceeds allocable to an increase in partnership minimum gain will cause each one to be responsible. So in other words, in this particular case, what's gonna happen to their capital accounts as a result of getting these distributions? They're going to go down by what? 60 and 240, right? And in addition, at the end of year 4, right, there's going to be another $200,000 of deductions, right? And the minimum gain is going to increase even further. So this is allocable because of distributions, DIST. This is depreciation. Negative 140, negative 560. What's the minimum gain here? Oh, 700,000. Not surprising. The capital accounts at G&L total negative 700,000.
Can you repeat what that regulation said? Distribution of non-recourse liability proceeds.
The distribution associated with non-recourse liabilities will give rise to minimum gain chargeback in the persons who receive it. Essentially, I'm paraphrasing.
Okay.
So, which makes sense. If you're the benefactor of a distribution, and the source of that distribution was a non-recourse liability, you should be tagged with the subsequent income associated with that. Right? Because normally, when you get a distribution from a partnership, assuming there's adequate outside basis, there's no income, right? I would agree? And normally, and when the partnership takes out a liability, I'm just going to give you some foreshadowing from Chapter 6, the outside basis will go up. So they will get this money, and partnerships love this, and partners, I should say, is the refinancing, they get all this money tax-free. But I won't say it's a problem, but down the road, they may get tagged with income. Amen.
So distribution will increase the capital account and will increase.
What? Distribution decrease capital accounts. Right?
Increase the capital account and also decrease their outside basis.
Yes. Think about it. All right, so let me give you a few more sites just because you would need to, want to. I think I shared with you before that this is reflected in the regulations under 704-2G1. 704-2G1. That this is a tough-like gain of $700,000, and they would be hit with this 140 and 560. Again, what is the title of this chapter, guys? The title of this chapter is Partnership Allocations. And the question is, throughout the entirety of this chapter, just thinking back, can these allocations work? And we saw in the first part of the chapter, as long as there's substantial economic effect, these allocations can work, right? Substantial economic effect, there's got to be economic effect. In addition, it has to be substantial. It can't be shifting, Brianna, or transitory. That's the first half of the chapter, right? We saw all the different allocations. You kept your capital accounts, right? And we saw what you had to do. You got to go back in your notes. The second part of this chapter said, and it has nothing to do with tax basis, right? In other words, it all deals with capital accounts because capital accounts are pivotal, right, to reflect your economic stake. And essentially Congress said, look, if these are properly reflected in your capital account, if you respect them, we'll respect them, okay? That's the message. That's why capital accounts are so important. The second part of the chapter, which is the part we've been focusing on tonight, is we can't respect capital accounts because the reality is, in this context, negative doesn't mean anything, right? Because usually capital account, when it's negative, means you got to pony up, right? Deficit capital accounts mean you got to pony up, right? But here, no one's got to pony up. If they walk away from the property, the bank can, this is me knocking, the bank can knock the knock and say, hey, we want you to pay up 140 or 560, right? G&L can say to the bank, you know, whatever, you get my message, you can't come after us. These have zero economic effect, agreed? All right, so the regulations say, okay, we'll respect this, not because it has substantial economic effect, because there's a minimum gain chargeback, because if you thumb your nose at the bank, guess what? You got to pick up this phantom gain, and we want you to pick it up in this orchestration, right? And you're willing to take the allocation, we're willing to respect it, as long as when all the dust settles, you're willing to bear the tax consequences associated with that minimum gain, right? That's what this is all about. So the first half of the chapter dealt with substantiality, dealt with economic effect. This has zero to do with economic effect. It has everything to do with the Tufts decision and how, if and when there's phantom gains, the parties have to bear the consequences of their allocations. And they have to be, Andrew, consistent with their other allocations. Whatever, as Dill was saying, reasonably consistent. No one's sure, but you sort of get a gist of what that means. Dill?
That whole anticipatory distribution thing is irrelevant here because they're already both negative, right? It doesn't make a difference.
In this context, it has no meaning.
Okay.
Okay? It has nothing to do with qualified income offset because that's only if you shouldn't have gone negative. Here, it's permissible to go negative because of the minimum gain.
Got it.
Karen and Evad? Karen first.
Well, G kind of has to keep two sets of capital accounts. I mean, if you have other stuff going on besides just this problem where we're just talking about non-recourse, he can keep going negative for other reasons and have to pony up. But just for these, he doesn't have to pony up at the end. I'm
Right.
trying to think of it at the end of the
Yeah, I mean,
day.
in this particular case,
What would-
but he'll keep his capital accounts just the way they are, but he may have to pony up not only because of the minimum gain, but because he's actually, he's a general partner and he's subject to unlimited liability. You'll see some more problems. We're gonna, next step, you're going to see something, where I think you're going to see what the point you're trying to make, Karen. Amen?
Just to get the visual for capital accounts, at the initial, G will have 80 and L will have 350. For outside bases, G will have 400 and L will have 1.6 million.
You're
Just
talking
like the
about,
visual between-
yeah, in general, yes. Because under 752, I'm keeping it we're going to do it in accordance with profits interest for the moment. So yes, answer your question. Fausto,
You're gonna go this exam.
we're going to have fun on the exam. You are too. I don't know what you want me to do. I mean, I can't, guys, this is not, let me torture everyone here and make it hard, okay? Partnership tax is hard, Fausto. I mean, I can't say otherwise, and I can't make it simpler. I can say this, you got to look at the examples of the regulations, you got to be able to do the problems we've done here and grasp it, but I can't it would be foolish on my part to say, well, we'll keep it really, really simple, because, you know, the reality is, people do not come to you for your services for really, really simple problems. They will only come to you for complicated issues, okay? So I'm not gonna make it mind-numbing, but if I just keep it at this level or even simpler, you know, you gotta be willing to dance with me. Andrew?
If G was only to make a contribution, like let's say he made a $200,000 contribution, would you allocate that evenly in the capital accounts between G and L?
Like, if who made it, what kind of
If G contributed $200,000 to bring down the loan,
Okay.
would you allocate?
I'm not gonna allocate anything to L. I mean,
You wouldn't.
listen, geez, capital accounts are sacrosanct. I mean, no offense, Andrew, if we're partners and you bring in 200,000, I don't think you're gonna allocate anything to my capital account. That's money you put in, unless we're father and son and you're giving me a gift.
No,
That's the only reason why allocations would be not going into your capital account. Okay, other questions?
Let me jump in, but what happens after 10 years when the loans pay all of it? So what happens to the capital account?
That's hard to say. What I mean is, there's too many open-ended questions anymore, so I can't even go there mentally. So just keep it this straightforward. Let me just talk for 5 minutes and more about some other things here and about the next chapter, then we'll take a break, okay? Now, so just keep in mind, again, one of the touchstones or differentiating factors of partnerships compared to any other business entity is the flexibility. But it's not flexibility that the government wants to come at the expense of the federal coffers. Meaning, you want to do whatever you want to do. First half of the chapter said it's got to have substantial economic effect. As long as it does, we'll respect it. Second half, dealing with non-recourse deductions, say, hey, we'll respect it, but remember, we'll give it to you with the caveat that down the road you may have to pony up. All right. There's a segment at the very end of the chapter dealing with what are called target allocations. And let me see if I can just boil this down. In yesteryear, Congress said, gee, people are driven by tax outcomes, and we want, regarding, they're motivated by tax, and they put the tax before other things. So whatever they do for tax, the other things have to follow in order. So whatever they're doing for tax purposes, their capital accounts have to follow in order. These partnerships arrangements in the minds of Congress were largely tax driven. But then came along Code Sections 465, 469, Code Section 77010, dealing with the at-risk rules, dealing with passive activity loss limitations, and if you recall, Code Section 77010, if I remember correctly, is dealing with economic substance, okay, that Congress codified the economic substance doctrine. So I'm not saying that killed tax shelters, but there's not as many people engaging in tax shelters using partnerships as there were in yesteryear. So people are really, at least people would say in the last 10, 15 years, much more motivated of using partnerships for economic reasons. And the tax issues are secondary. So it's the reverse of what we saw during the 70s and 80s and 90s. And now for the last 20 years, partnerships, when people come to your doors, they're going to be more inclined to say, hey, we have a great business idea. And you're going to say, listen, we're going to have your business idea, meaning however you want the cash to go in my original partnership arrangement where Dill and I were partners, whatever cash arrangement we have, we're going to have the capital accounts follow our cash arrangement. We're going to have these targeted allocations, meaning we're going to decide how we want to split the money, and however we split the money, we're going to write a partnership agreement that the capital accounts should follow that. Not the other way around. You recall last class where we had the capital accounts and then whatever they were, that's how Dylan and I were gonna split our profits. To the contrary, we're gonna write this in a funky new way, which says essentially, we're gonna come up with whatever partnership complicated formula, and we're gonna really think about how we wanna split up profits. Then we're gonna have some jargony language that say, however we decide to split up the profits, that's what the capital account should be, period. And that's what's called targeted tax allocations. And we're looking at something that's developing, okay? There's no regulations written on this yet, but many partnership agreements, instead of having, I'll call it the standard language that the authors give us some boilerplate language that they say, see, maintain your capital accounts and qualified income offset and all that stuff. Many partnership agreements have this very loose and goosey language that just say, hey, we're going to try to get certain profits and capital accounts should fall into line. I'll just leave it at that. This is still developing. Whenever the authors come out with the next edition of the partnership book, maybe we'll have better resolution. So if your notes, I don't want you to drive yourself nuts. I'm just, if and when you guys practice partnership tax, I just want you to be aware. The name of what's going on now are these targeted tax allocations. Doesn't mean what we're doing tonight or what we did last class isn't worthwhile. It's important to understand that allocations have to have these indicia, but I'm just saying that there is a general practice afoot in the United States where they're taking this verbiage, targeted tax allocations, and sort of saying, hey, I still think you still have to be careful about shifting, transitory, and other things where if your clients have some games in mind, you can't say, oh, well, it's targeted, that means it's okay. All it's saying is, you know what, Dylan and I, we're motivated by the economic arrangement. We're not doing this for tax reasons. So whatever we do should get the blessing of Congress, okay? So anyway, I'll leave it at that. I still need you to know the material in this chapter, but I just want to call this to your attention that this phraseology, targeted tax allocations, has become in vogue, but to date, the IRS has not opined on its legitimacy, although I will say this, it would cause an uproar if the IRS at this stage said that they consider this illegitimate. So I am sure in some form or fashion, they're going to sanction its use. All right, let me just tell you before the break one other thing, that we are about to embark on Chapter 5. Chapter 5 is like Chapter 4, not for the faint of heart, okay? If you didn't get that message already. So I need everyone to be ready to give me not 100%, not 200%, but 300% of their attention because Chapter 5 requires that. Final word, if you recall at the beginning of class, for those who came in late, if your calendar permits, the first 3 or 4 people who are interested, November 17th, getting some continuing education credits, just let me know, come up during the break. 9 minutes, I need you back here, 10 up, okay?
What time is this event?
It's an all-day event. 7:30 a.m. until 1 p.m. half day.
What is it?
November 17th.
And where?
It's at Hanover, Mass.
Okay.
Yes, I will.
Right? And yes, the assignment of income doctrine does take a back seat, right? When it comes to partnerships. However, if you turn to Code Section 704 C1A, might as well keep it open. It says, C1A, income gain, loss, and deduction with respect to property contributed to a partnership by a partner shall be shared among the partners so as to take account of the variation between the basis of the property of the partnership and its fair market value at the time of contribution. In other words, and the authors make this point in the background material, they do not want people like myself and Bill to enter into a partnership agreement where, or a partnership arrangement where he might be a low-income taxpayer, I'm a high-income taxpayer, and as a result of entering into this partnership agreement, I contribute property, and we then split the gain. Okay, it's depreciated property, and we use the partnership, right, as a mechanism, as a vehicle to income split, right? Or conversely, Bill contributes property, which has a large built-in loss, and since I'm a high income taxpayer, I welcome him into my lair, and I say, come on, as a result of that, I can use his loss, right? Everyone get the visual? That Congress is not going to be a big fan of people utilizing partnership agreements, partnership arrangements, to share built-in gains and built-in losses, okay? And that's going to extend to the gain that is recognized with respect to such property, and it's going to extend to depreciation deductions as well, because depreciation deductions too can be manipulated if there's a built-in gain or built-in loss, all right? So, like many facets of taxation, this is no exception, if you are able to role play here, I promise you, I should say, so if you guys are up with pop music, I promise no promises. Okay? I know, sorry, but that's what happens when you're on the treadmill too long. You hear all these songs. But I think I can promise you that if, with respect to these sort of allocations, that you have to, I was getting to the point of role play, and ask yourself if you're the non-contributing partner, what's fair? Okay, what's fair? And I think this will resonate once we go through some problems, but the regulations essentially say, and here guys, we are going to be looking at both book accounts and tax accounts, okay? So we're going to look at both. We're going to have to keep book records, and we're going to have to keep tax records. And which one is going to dictate the tax outcome generally? The book records. We got to, whatever the book gain or loss is, we're going to see that tax is generally going to have to follow the book arrangement, okay? And you'll see in a moment what I mean by that. So the authors go through the background and they talk about the fact that Congress is concerned in Chapter 5 with income shifting, right? Income shifting is a no-no. We learned that in what case? Just to remind people, and again, get you ready for the upcoming weekend. Lucas v. Earl, right? Apple on the tree, right, Alicia? You're eating an apple just in honor of Mr. Earl, right? All right, so good. I like the spirit that Alicia is showing vis-a-vis her apple. All right, Lucas v. Earl, right? All right, but Lucas v. Earl is present there. It's present here, right? No income shifting. Okay. So the authors then talk about what I'll call general principles of Code Section 704C that you have to take into account: built-in gains, built-in losses. And we're going to learn that there's not one, not two, but 3 methods to handle this, okay? And then I'm sure you're excited. Not only 1 method, 2 methods, 3 methods, right? The 3 methods and that, do you recall what they are? You didn't get there yet? Edward, you know what they are? Traditional. Traditional with curative allocations, and then the remedial method, right, Amber? Okay. No. Traditional, 1. Traditional with curative allocation, 2. Remedial, 3. Okay? Each one is unique. Each one presents its own challenges. And we'll start off with the traditional method. You have sales and exchanges of contributed property. This starts a discussion on page 158. And the goal line here is expressed in the first sentence, or in the first paragraph under traditional method. As to the non-contributing partners, the goal of the traditional method is to allocate tax gain or loss equal to their share of book gain or loss, okay? So the non-contributing partners should have the tax consequences follow the book consequences.
Sorry,
Say again?
158.
Page 157. Okay? Notice as the authors go through this, and this is common, by the way, where do you think the authors pulled their examples from? I know the regulations. And for exam purposes, Busto, where do you think I can pull my questions from? The regulations, right? Can you answer that question? Right? And there's the so-called ceiling rule, which we're going to see how that operates, because sometimes the book consequences suggest something, but there's not enough tax deductions or income to equal the book, and that's just life. So we're going to deal with something called the ceiling rule, and we'll see how that comes to play. But notice how the authors are suggesting, and this is vis-a-vis the regulations, you got to keep two sets of books. You got to keep your tax records, you got to keep your book records, or capital account records. Okay? So we'll see how the traditional rule operates, and then we'll see the traditional rule with curative allocations, where you try to make sure that the tax consequences follow the book consequences, and you manipulate income you have going on in your books. And then the remedial method allows you to essentially create income that isn't there, or create deductions that aren't there. But the price tag for creating income or creating deductions is that there's a quid pro quo. Whatever you create on one side of the equation, you've got to create an offsetting amount on the other side. So it's sort of a little bit like magic. You're able, out of thin air, create income or create deductions, but theoretically the government coffers are not the losers. Why are the government coffers not the losers? Because there is an equivalency. You must create the same income or deductions on the other side of the equation. All right? So, again, three methods. The traditional method falls short, often falls short. The authors say, why do we still permit the traditional method? You'll see shortcomings in a few minutes. We keep it because it's the easiest, okay? Easiest to understand. The remedial method, the traditional method with curative allocations works. A little bit more complicated, doesn't always work. The remedial method always works, but it could be perceived as being complex, particularly when it comes to depreciation issues. All right? So we're going to go through this. You'll see how these work. I just called your attention. Code section 724. If you recall, when we started class several weeks ago, we talked about forming a partnership and that you contributed property into the partnership. And once the property was in the hands of the partnership, would its character remain the same? Code section 724 says that in certain instances, the character does remain the same. For example, accounts receivable, the character will remain the same. Inventory, for the next 5 years, you contribute inventory, it will not lose the market gain. It will stay as inventory for the next 5 years in the hands of the partnership as inventory. So you can't transform its character by simply, if you're a real estate dealer in real estate, you can't just transfer real estate to a partnership and then say, gee, that's not inventory, it's an investment. it's gonna maintain its taint as inventory. And then capital losses, if you contribute property with a built-in capital loss, the capital loss will stay capital loss, okay? The built-in loss portion, anything above the built-in loss, okay? Anything above that, in excess of the built-in loss, will take whatever character that lost property is in the hands of the partnership. All right, so code section 724 is a preservation of character code section, right? It does not want people to manipulate the partnership in order to achieve good objectives, tax objectives. Okay, so part 1 of the chapter deals with sales of contributed property with built-in gain, built-in loss. There's a short segment here in code section 724 that just reminds the reader that character will be preserved. And then there's a discussion of depreciation, okay? And using the 3 different methods, how is property or depreciation deductions allocated? It is not always easy. Okay? There's the traditional method of depreciation. By the way, for exam purposes, just to allay concerns, the depreciation computations will not be challenging. This is not a course on depreciation deductions, okay? So that's not going to, the question is not numerically what is it, okay? That I'll help you with. The question is how should that depreciation deduction be allocated, okay? So you may have other concerns. Your concern tonight, your concern next week, or your concern for exam purposes should not be depreciation computations. It's how to allocate, okay? And again, you have your different methods. Traditional method of allocating it. You have your traditional method with curative allocations, which are pretty simple. And your remedial method, which is not for the faint of heart, okay? Which we'll see actually creates 2 assets, the remedial method. The first asset, that it obviously it's hypothetical, right? The remedial method, because there's only one asset, truth be told. But the remedial method actually creates 2 assets. The first asset is deemed to have a fair market value equal to the adjusted basis. And the second asset is considered to have a basis of 0, fair market value of whatever the appreciation is. You'll see what I mean in a moment. This is spelled out on page 160, 4 lines down from the top of page 160. This is under the residual method, the portion of the partnership's book basis in the contributed property equals the tax basis of the property at the time the contribution is depreciated under the same method used for tax depreciation. And then the next sentence talks about what's considered new property, the amount by which the book basis exceeds the tax basis. And then you treat that as if it's newly acquired property. And then it gives an example, all right? If you don't see it, don't worry. We will go through an example. It's not easy to follow this. But in the regulations, there's no surprise. It's spelled out right there. Keep in mind that when you have an existing partnership, and remember when we form a new partnership, people like Tamara and I might form it, we contribute, or I contribute property where the basis and fair market value may not be the same. And the regulations say we have to take that into account, right? Everybody agree? But suppose Tamara and I are operating a partnership, we've been doing this for many years, and then Annetta wants to join us, okay? So, and she contributes cash, pure cash, okay? In that kind of circumstance though, remember the chances are, suppose Tamara and I bought a building, and we spent $100,000, and just keep the depreciation, we're gonna keep it really simple. We depreciated it down to $50,000, and now the property is appreciated up to $1 million. Great investment that we made, okay? Everyone have the visual? And Annetta wants to join us. How much does she need to put in to join us? $500,000, right? She wants to become a 1/3 equal partner. Agreed? But picture, if you will, she's coming into a partnership where the tax basis is equal to 50,000, right? Because we've depreciated, we bought it for 100, depreciated down to 50. The property is worth $1 million, right? Going forward, is there much in the way of depreciation left? No. And the regulations, and this begins the discussion on page 167, the regulations cite at the very top, 704-1B4, one little I, and the examples the authors cite you to. This is on page 167. Says, in that situation, even though Annette is contributing pure cash, and Tamara and Solid are not contributing partners, right? Everyone agree? We're treated as if we were contributing partners, even though the partnership has been in existence and we're not contributing anything. Everyone agree? We're not contributing anything. But the principles of what's in the earlier part of this chapter still have to apply, meaning that it's as if, hypothetically, we had contributed property to this partnership with an adjusted basis of 50 worth $1 million, right? And Tamara is de facto treated as if she were a non-contributing partner, and she will want her fair share of the depreciation deductions and things like that. So hypothetically, if the property were sold the next day after Annetta comes in, okay, there's going to be a $950,000 gain in my example, right? Should we split that gain 1/3, 1/3, 1/3? No, even though, again, technically, 704C1A does not apply because this is not contributed property. Right, everyone agree? That Tamara and I would have to split that gain 50-50. We would be saddled with that gain because otherwise there would be income shifting, right? This is an anathema to the code, if I pronounce that word right, where she should not have to pick up any gain in those circumstances. Everyone agree? Right? So again, that's a little bit of a reverse of contributed property, but the principles we all agree should apply in that context. Right? There's an example the authors give of that. So fear not. Do not worry because I'm not going to ask for the midterm, maybe the final, but not the midterm. On page 168, there's a discussion of distributions of contributed property. That's in a later chapter. We're going to deal with distributions of contributed property in a later chapter. You have a lot to worry about. This is not one of those things you should worry about, at least put it this way, not yet. Okay?
So the midterm is chapter 1, chapter 4.
No. Worry about this chapter, Louise, not this small section. Okay? Page 168, 169. Don't worry about that little segment. Everything else worry about. All right? There's an anti-abuse rule which pertains to lost property. All right? And we'll see this in action. Not surprising, Congress wants to be very careful when it comes to lost property, that there's no shifting of those losses to undeserving partners, okay? No shifting of those losses to undeserving partners. All right?
So yeah, partners that would be shifting losses, what are they getting out of it? Obviously they're shifting it because they can't use it, but what are they getting in return?
They may get something later on.
Okay.
Okay, so we don't know what they're getting. All right? We don't know yet what they're getting.
I can't imagine it's an altruistic thing, so.
Well, they'll see. All right. Everyone ready? Because again, we need to get through this because we need to be on time with what we need to get through. So, problem 1. A, B, and C form equal partnership. A contributes to accounts receivable for services. Adjusted basis is 0. Fair market value is 10,000. B, a real estate dealer contributes lots held primarily for sale. Appreciated value from 5,000 to 10,000. And C, an investor contributes land. Unfortunately, the land was a loss leader, right? Just basis of 20, fair market value of 10. Unless otherwise stated, the partnership is not a dealer in receivables. For land, all contributed assets have been held long-term by the partners prior to contribution, and the traditional method of allocation is applied with respect to all contributed properties. What are the tax results in the following alternative transactions? The partnership sells the accounts receivable contributed by A for $10,000. Okay, so remember, A contributed this property. What's the partnership's basis in this property? What is the partnership's basis, if you remember from our first class? Or second class? What's the partnership's basis in this property? Zero. Code section 723, right? Remember that? So even though it's got a $10,000 book value, for the partnership it's got a zero tax basis. So if it's sold for $10,000, is there any book gain here? Book gain. There's no gain on the books, right? Zero gain on the books. Is there any tax gain? Right. There's a tax gain of how much? 10. Okay. So under regulation 704-3B, I'll repeat, regulation 704-3B, all $10,000 is allocated to A. Okay? And under code section 724, it's all ordinary. Everyone agree? The character of the income is going to remain ordinary. I don't think anyone's surprised by that outcome. A, create the account receivable, A should be tagged with it. Agreed? Question B, partnership sells the lots contributed by B for $10,600. What are the lots in the hands of the partnership?
They're essentially inventory.
They're inventory, right? In code section 724 D2, 724 D2 is going to preserve their character as inventory.
May I ask something? For whatever reason, I thought that land cannot be inventory because each piece is different. It's
No,
not true.
If you sell land, a piece of the land, that becomes your inventory. Absolutely, Alicia. Land can be inventory. All right. So if it's recognized during the first 5 years, it's always inventory, right? The taint, it will remain inventory. Here, we're told the partnership, I'm not sure when it's sold, but assuming it's sold in the first 5 years, it's definitely in ordinary income. Okay? Now, what's the book gain? 600. How's that get split? The book gain? Equally, right? $200 a piece, right? And what about the tax gain here, the $5,600? 5,000 would be allocated to B, and the other 200 to each partner. So B gets tagged with 5,200, and the other two partners get tagged with $200 a piece. What's my authority for that? 704-3B. 704-3B. Everyone see that? That the book gain here is $600. We've agreed, Annetta, Tamara, and I, to split that, right? 3 equal ways. But if Tamara brought this property to the table, she should be tagged with a built-in gain of 5,000, right? So she'll be tagged for that 5,000 plus the additional 200 and Annette and I will each be tagged with $200, right?
Does
Okay,
that entire tax gain show up on the 1065?
Does the entire tax gain show up on the 1065?
Or is that essentially handled like outside of the?
No, it's gonna be show up on the 1060.
Okay, just special.
Got to. Yeah.
I didn't know if it'd be like a footnote on a K1 that you say, hey, you also have this additional crap that we don't recognize as part of the budget.
Oh, I mean, the K1 will reflect the differing gains, but the K1, the 1065.
It will be on the face of it.
Okay. Question C, suppose the property is sold instead, right, for $9,100, right? What gain or loss here? Loss of how much? 900, how is that gonna, or how are our capital accounts gonna be reflected? Evenly, right? Our capital accounts are gonna go down by $300 a piece. Everyone agree? Now, assuming again in my fact pattern, Tamara's B, she brought this property to the table. How's she gonna be tagged with the tax outcome? What is the tax outcome? How much tax is there?
A gain.
Gain of how much?
4,100.
Gain of 4,100. Who gets tagged with that?
B.
B, in my example, Tamara, right? So in that case, we each have $300 worth of book deductions, right? But there's a tax gain here of 4,100 that Tamara's going to get tagged with as the contributing partner. And under the ceiling rule, we, the non-contributing partners, are unhappy because Annette and I would like to get our losses, right? But we can't. Everyone agree? We can't. Unless there's the traditional method with curative allocations or the remedial method, right? So, under the traditional method is under 704-3D. Tamara gets hit with all, or taxpayer B gets hit with the entire $4,100. Okay, the ceiling rule applies here. Now, do bear in mind again, you could use the traditional method with curative allocations under 704-3C, or the remedial method under 704-3D. Okay? Two other methods. Question D. Say to C above, except the partnership elects to use the remedial method of allocation. Okay? Think to yourself, if there's a remedial method, we can pull out our magic wands here, right? Everyone has, pretend your pen is a magic wand. And what are you going to do here? Evelina, with your magic wand, what are you going to do? You're not sure? Jahadi? Not sure? Go ahead, Eric.
Do you allocate $900?
Unless
Who are the people? So Eric, you said what?
$900 of gain to B and then losses to.
What? We know? Okay. Let's put it this way. In my example, Annette is A, Tamara's B, I'm C, right? And we each want, Annette and I each want $300 worth of losses, right?
Right.
So the partnership can manufacture them, right? Give us the loss, but there can't be any leakage here to the government. So if we each are getting $300,000 worth of loss, who's going to get tagged with the $600 worth of income? Tamara, right? So Tamara not only has $4,100, right, of income, right, on the normal gain, she has an additional $600. Her total income is how much? $4,700. Okay, everyone agree? But that's okay because Tamara, and she originally, remember, she's effectively still getting a $300 loss here, right? Because remember, when she contributed the property, it was embedded with a $5,000 gain, right? And she was only picking up $4,700, right? So isn't she de facto getting a $300 deduction? Everyone see that? So again, for your notes, yeah, I'm about to. The net, taxpayer A, solid, taxpayer C, each will get a $300 loss because that reflects our book losses, right? Everyone agree?
So we're getting in a tax.
I'm sorry? So we're each getting $300 worth of losses for tax and book purposes. For tax and book purposes, A and C are each getting $300 worth of losses. And Tamara's going to be tagged with $4,700 worth of taxable income. And she also is going to have a book deduction of $300 for capital account purposes. And that's okay because at the end of the day, we're all going to have the same capital account and tax account there.
Right, because in C, you and didn't get any tax loss for it. Without the remedial allocations.
Without the remedial,
right.
because of the ceiling rule, we would not have gotten reductions otherwise. So notice, go ahead, Megan.
I just wanted to confirm, you said that the book and tax gain for B will be 47, it's the same.
B will get $4,700 with $4,700 of taxable income, ordinary income.
Oh, and then book he gets the 300 loss.
And we each get a $300 loss for tax purposes and book
So
purposes.
it's just the same book tax for A and C?
Yes.
Okay.
And it's the whole objective of the remedial method, right? Because Annette and I feel deserving of a $300 deduction. We lost economically $300. Under the traditional method, we couldn't get it. Okay? Okay. Question E. The partnership is a real estate dealer and sells the land contributed by C for $17,000. Now, let's go back to our fact pattern. C contributes land with a built-in loss of $10,000, right? Everyone see that? Built-in loss of $10,000.
But C was an investor before.
I'm sorry?
C was an investor before.
Was an investor, so it's a capital loss, right? Under 724, the character in the next 5 years at 10,000, up to 10,000 built-in loss, is going to be a capital loss. Yeah. If it's sold for 17, is there a taxable gain or loss here? Loss. How much?
3,000.
3,000. Who should get that loss? C, right? Everyone agree? C is the one who brought it to the table, this property with a built-in loss. Everyone agree? In fact, for book purposes, is there a gain or loss? Gain of how much? And who should share in that? All of them. By how much? $2,333, right, a piece. Everyone agree? Capital accounts here should go up by $2,333.
I missed one thing.
Hold on, before you go there, does everybody understand that for book purposes here, in this problem, that this property appreciated for book purposes, everyone should get $2,333, their capital account should go up. Everybody agree? And we agree, if this was traditional method, notwithstanding, only C gets the tax loss. And even though we, in this case, Annetta and Tamara are A and B, solid is C, if you recall my, only Annetta and Tamara, their capital accounts go up, but they don't have to bear tax consequences with that, right? Under the traditional method. Okay, so the answer for for now is that under the traditional method, again, book accounts go up by $2,333 apiece, and solid taxpayer C gets a $300,000 write-off, right? But if this was a remedial allocation, right, what would happen is that they would each have to be pegged, Annette and Tamara, with $2,333 worth of taxable income. Everyone agree? And I would get an offsetting, a larger deduction here, right? I would get whatever taxable, I could get an additional $4,667 worth of tax write-offs, right? Because, hey, they now paid their tax burden. There should be an offsetting deduction to me. Yeah.
Capital or ordinary?
It should be capital, whatever the taint remains with the property.
Okay, oh, because the book gain was.
The loss, embedded loss was 10,000 capital loss.
Right, okay.
Alicia, you had a question?
What was the question about the?
All right, so again, there's two different possible answers. One is the traditional method, which again leaves Annette and Tamara with economically better off because they've got a capital account that goes up by $2,333, but they don't bear any taxes. And then there's the remedial method, which is probably the more appropriate method because you guys get back to Code Section 61. If you're economically better off, Code Section 61 should dictate that you have an accretion to wealth. They should be taxed, and under the remedial method, they would be. But hey, we're manufacturing that income, so there should be an equal and offsetting deduction. Who should that go to? Well, it should go to Solid because I'm the one who brought this property to the table with this such a large loss built in. So I should be entitled to get that benefit. Andrew?
So C would get the total $9,666 in losses?
No, I think you did your math wrong.
766.
766.
What was the character on each one?
Capital loss.
For everybody?
Well, remember,
That on C?
when you say that, when it was sold, okay, and it was sold at a gain, the real estate dealer and they sell the land contributed. That's going to be ordinary income, right? In the hands of the partnership if there's a gain, right? The gain part now in the hands of the partnership. The capital loss keeps its taint, and here now it's in the hands of the partnership, and they're using it as inventory. It's going to give rise to ordinary income. Okay.
And then, and on the traditional method, the 3,000 loss to C, is that
Capital loss.
capital loss?
Yes.
And on the remedial method, the 2.3 for A and B,
That's going to be, in that case, ordinary income.
and the 7.6 is capital for C?
Yes.
Okay, yeah, so A and B get ordinary income, but you get capital loss.
Yes.
Okay.
But so if you're splitting it 3 ways, wouldn't C also have income as well?
They do, because effectively, if you take the number, their overall loss, we said, was 7,666. Keep in mind, they originally were gonna have a $10,000 loss, so they effectively got $2,333 worth of income. See what's going on there, Luke? Question is, same as E, except that the sale price is now for $7,000, okay? Suppose the property sold for $7,000. And how would this be treated? Under the traditional method.
loss.
$3,000 book loss allocated $1,000 a piece, right? Everyone agree? $1,000 book loss allocated to A, B, and C, right? Because the property was worth $10,000 in the hands of the partnership. It declined to $7,000. So economically, each one's out $1,000. Amber, what was your question?
Mine's on the tax side.
Oh, you gotta talk louder.
My question is on the tax.
Okay, on the tax. Who gets saddled with the tax? How much of a tax loss is there?
13. He's only has a built-in 10.
Okay, there's 13. The built-in loss is 10. Everyone agree? What's the character of the built-in loss?
Capital.
Capital. What about the remaining 3? Ordinary, right? That's how 724 works. The first 10, the built-in loss keeps the market gain, 10,000. Who does that get allocated to? That 10,000 loss? C. How about the remaining 3? A, B, and C, right? Everyone agree? A, B, and C. So would each get $1,000 for the remaining 3,000. What's the problem, Evan?
So each one will get, A will get 2,000 worth of loss.
No. A will get 1,000, B will get 1,000, C will get 13,000, right? 11,000. 11,000. Right, Eamon? We got 13 to cover.
Right.
And economically, they lost 1,000, and I should be entitled to 11,000 because I'm the one who brought this lost property to the table. Okay, everyone got that? 1,000, 1,000, 11,000. Question G. For the resultant ending of the above transactions change if all the sales had occurred 6 years after the property was contributed. And this just gets the issue of code section 724. 724, remember, with respect to inventory and the built-in capital loss, the taint remains on the property for 5 years, not 6, okay? So just bear that in mind.
So in F, C would get $11,000 of ordinary loss.
Yes.
Okay.
So problem F, for example, C would get 11,000 ordinary loss.
Next question. What was the, on E, the remedial method, what was the character for C? Was it a split between ordinary and capital? Or was it all capital loss? E, where C had the 7,600 to loss, was that all capital or?
Yes, it was all capital.
But then how's there a different amount of capital loss for the remedial method than the traditional method? I thought they should be.
They don't look for symmetry here.
Okay.
The outcome will not be symmetric. Right? There's no promises, okay? Like the song, can't promise no promises. There's no promise of symmetry. Okay? And I know too much about the song because my daughter goes to Bucknell, and the cheat codes, for those who don't know, are coming to Bucknell to sing that song. So I know a little bit too much about the song. So anyway, Louise, you had a question.
The answer for G, capital ordinary loss for C.
Well, G just talks about removing the taint, okay? That if the property is held for more than 5 years, you don't have to worry about code section 724 anymore. Okay? Go ahead.
I just to confirm on back to Ed, the 11,000 to C, is it 10 capital and 1 ordinary?
Yes.
Yes. Go ahead.
For E, with the land, when you were saying that the full capital loss to C under the remedial method would be the 7,666. So you're netting what technically would be an ordinary, because the 2,333 is ordinary income to A and B.
Right.
So you can net it at C instead of having 10 of the ordinary, 10 of the capital loss.
You're effectively netting.
Okay.
Yeah, you're not going to get, it's not a beautiful outcome, eloquent outcome. It's sort of remedial method, you're pulling it out of thin air.
Okay. So it doesn't like keep you it doesn't require you to keep
That
it.
doesn't require it, okay? Kelly?
All of these losses, both embedded and the remedial method, these are still subject to the loss limitation hierarchy, correct? The seven.
I mean, you always have to worry about the loss limitations under average or passive activities and things like that. Those always, these don't feed the door to allowance. This just tells you permissibility about the allocations. And how, in this case, notice, last chapter, that was permissible. Everyone agree? What the authors are trying to, in case you missed it, and I don't blame you, you're trying to absorb all this, but the last chapter talks about the flexibility, right? You could do essentially as long as, again, whatever you want, substantial economic effect. This chapter says, hold on, not so quickly. With respect to contributed property, or instances where someone else is joining the partnership, some allocations must happen, right? You can't willy-nilly just allocate income or losses away. Everyone understand that? Notice the vast difference between what we did last chapter and its flexibility, and just how frickin' inflexible this whole arrangement is. Everyone agree? This is not Congress saying, go for it, whatever you want, we'll honor. There's no knee bending here, right? Okay, other questions? Okay.
Going back to E, so why is the remedial method 7.62C is all capital instead of being 3 capital and 4.6?
Remember, the remedial method doesn't talk about capital. The remedial method talks about the tax implications.
Right, I'm talking about the tax write-off of 7.6.
Of what?
The tax write-off for C of 7.6.
Right?
Which is 3,000, the original capital loss for him, and then.
Plus the remedial $2,333 allocated to each of the other partners.
So why, for the other partners, that would be ordinary, but then for him, it'll still be capital?
It will be a loss because the 724 requires the taint of a capital loss. Look at code section 724. This was a built-in capital loss. All right, take a look at that.
We're struggling with the difference between E and F, but I think the answer is that F completely covers the tainted capital loss of 10. And E, he still has a built-in loss left over, so that's why.
Because 7.6 is less than the 10 built in.
Right.
Okay, I got it. Thanks.
Let's just, I want to show one or two examples because for Wednesday, next week, it's important that you guys be able to handle question 2. So let's look at one or two of these questions for make sure you guys are following because these are important and you got to make sure you're comfortable with these. Okay, question 2. Assume A contributes $100,000 cash to the partnership and B contributes a building with an adjusted basis of 50, fair market value of 100, okay? Everybody have the visual. And this time, Edward, you're joining forces with me, okay? And Edward's the cash guy, I'm the building guy, okay? Everybody have that? I'm contributing the building, Edward's contributing the cash, okay? If the building is depreciable, has a 10-year remaining recovery period, is depreciated under a straight line method, how much book and tax and book depreciation will be allocated to each part? So everyone can handle the math. It's, the building is worth $100,000. It's got an adjusted basis of 50, right? So for all these guys, let me recommend that you have your tax and book, okay? You got to keep it for both. Everyone agree? Tax and book. What is our capital accounts? And that's again, AKA book. What's our starting tax and, what's our starting capital accounts or book accounts, guys?
Cash, so it's 100,000 for J, both.
100,000 for both. Everyone agree? That's our economic deal. Edward and I are going into this deal. We're each going to put up essentially $100,000, right? Adrian, what's our tax accounts?
150.
Who gets the 100? Who gets the 50? He puts Edward put it up to cash. I put it up this. This is my outside tax basis under Code Section 722. Agreed? Everyone should be able to get this far, right? Okay? Now, I'm just going to call to your attention, there's a regulation that you got to use the same depreciation method for tax and book purposes. For tax and book purposes, you got to use the same depreciation method. What's my authority? Regulation 704-1B2, 4 little i's, G3. I'll repeat, 704-1B2, 4 little i's, G3. So first thing the regulations say to do, this is under 704-3B, 704-3B, is figure out the book depreciation first, okay, and then allocate the tax depreciation to the non-contributing partner, and the balance going to the contributing partner. So first we got to figure out the book depreciation, and then we're going to allocate the tax depreciation. So Dawn, how are we going to do this? How much depreciation is there, Dawn? How much?
10 years, okay, so 5,000.
So there's a total of 10,000 of book depreciation, right? And since Edward and I are equals, right, Edward? We each get 5,000, right, Dawn? So our capital accounts are each going to go down by 5,000, no surprise. Chad, how are we going to allocate the tax depreciation? And now to see if you agree. Chad, how are you allocated? How much tax depreciation is there? 5,000, right? Because there's only, the building is worth 50, or excuse me, the adjusted basis of 50, right? Divided by 10, last I checked, is 5, right? So, Chad, who gets that 5,000 of tax depreciation?
B.
Who is B? B.
Because he's the being partner.
You give it to B, but Edward says, look, I contributed cash. Who's more deserving? Right? It's as if they had gone out there, if I contributed cash and Edward contributed cash, and we had gone out there and bought a building for a fair market value of $100,000, our adjusted basis would be $100,000. There should be $10,000 in depreciation. It's only because I brought to the table a building with a smaller tax basis than fair market value. He's going to suffer the consequences, but he says, I don't want to suffer the consequences. And the regulation says he shouldn't.